Hey, welcome everybody to the 40 Finance channel. It's a very volatile situation out there in the market over the past, it's really been 5 or 6 days now. I think this started on Black Friday a little bit and it's continued on through the week. And today starting out a lot like yesterday did, where the morning has been mildly positive. And we'll have to see when we get into the afternoon if stuff kind of breaks down. I'm watching the QQQ in the corner of my eye here, and it's down just 0.23% right now, but it has had a low of 0.65, and it actually, I think it opened positive for a second. So a lot of weird stuff going on, a lot of sell-offs in the growth names, which I think, there's a lot of us who have been saying those have gotten too hot. And that's starting to look like other people are buying in to that argument as well. But through this whole thing, over the past 7 days, let's just call it the past 7 days, obviously there's a lot of chatter about a crash or a correction. We're in a crash, we're in a correction. And despite the terminology you might use, I'm here to say that we probably have a long way to go before we can even talk about a correction. And I want to take some of the big names and show you a few things just to give my perspective. I am 100% bullish on investing still, and I'm looking for opportunities. So this is not a negative video in the sense that stocks are going to explode and die forever. This is more about, you're never going to time the floor. And I've already started buying a few things, but just some of the signals that I'm looking for, like, hey, maybe we'll get closer to a floor if we see these couple things. So that's what I'm going to jump into today. And once I get sort of established with those points, and of course, I'll come over and do the questions. I see Jimbo Jones is here. Thanks for typing in a chat so we know that that's working. But let me go over the reasons why this is not a stock market crash until, at least from my perspective, we see these things. All right. So let me transition here to the QQQ, and actually I'm going to refresh it real quick. Just make sure I have the latest and greatest stuff here. So QQQ, I mentioned, down just a little bit today, 0.19%. This is a 1 month view. And the big thing that I'm looking for personally in the QQQ, and if you follow the channel, you know that I'm building a position in it right now. I'm looking for a lower RSI than we're seeing, okay? So 35 is okay, I guess you could say, but it doesn't really strike me as super exciting. So if you pull it out to a 3-month view on RSI, it's definitely trending down. But if you even just go back, and hopefully you can see in the bottom left corner, there's a purple digit that shows up, and that tells you what it was that day, I believe at closing. So late September into the first part of October, we had 20s, 24, 23, 21, and then back on September 20th, we had 21, 23. So considering that the QQQ in general, let's see what the total's been over this past 5 days. Is that 1126? Is that, I think that's Black Friday. But anyway, the close, as you can see, was 397. Today, you're at 386. It's not a huge drop, all right? That's not a huge drop at all. In fact, I would argue that the top 100 stocks in the stock market right now, whether you go by QQQ or the SPY 100, they're all doing pretty good considering how many people are out on Twitter, crying about their losses. And I've taken my share of losses in this week as well, as you guys know too, most specifically Visa and PayPal, which are my big dogs of my portfolio, and they've come down quite a bit, and to some degree it's been surprising, but on another side of the coin, you can definitely make the argument on some of those multiples. So the QQQ is one indicator right now for me where I'm saying, hey, and look at this on the 5-day level. You're at 37. I'm not saying that's high, but that's not woe is me by any stretch of the imagination. We did have, it looks like yesterday around 12 or 1 o'clock, you did get into the 20s a little bit. So you had a dip down here into, wow, you got to an 11 there on November 30th, almost at 11 o'clock. So there's room for the Qs to go down more, at least from a sentiment standpoint. All right, and while we're here, I'm going to bring up point number 2. And I actually tweeted this yesterday, but not that I have a ton of followers on Twitter. So Tesla, all right? There is no way in heckfire that we are going to have any sort of crash without Tesla losing a bare minimum of 10%. All right, there's no argument that on traditional fundamental valuation that Tesla is overvalued for the next year, year and a half, probably more like 2 or 3 by any fundamental measure that you look at, okay? And I'll show you those fundamentals in a second. But the truth of the matter is with Tesla, it's such a unique company that you can't really, like, I get it. It's hard to compare it to GM and Ford and so forth. I don't think I would compare Tesla to those companies from a fundamental standpoint. So it makes it hard to say in Tesla's industry they should be trading at XYZ, right? So for me right now, during this time, I kind of want to see, you know, sort of an RSI view on Tesla, like how's the selling going? How's the strength of the stock? And right now, at the close of yesterday, you're at 42. You're higher than the QQQ, okay, for Tesla. And Tesla is the 3rd, 4th, 5th biggest position in the QQQ. So it certainly carries a lot of the market-weighted indexes, market cap-weighted indexes. And until this thing goes down a little bit, I'm not predicting a crash and none of that stuff. Until Tesla goes down, I don't think you can even talk about a stock market correction. And if we go to the 3-month chart here, 42 is the lowest since September 20th, very similar to QQQ. And, you know, it's trading far above the 50-day and the 200-day. We're not even close yet. So if the 50-day is 976, you're $100 over that. So basically 10% that I would say bare minimum Tesla would need to fall before you could even use the word correction. And let's just take a quick look at Tesla fundamentals. I don't really, I'm never quite sure what to make of Tesla fundamentals because of the problem that you have comparing it to other companies. Let me see if I can bring this up. Here's a live look at the tickers. So S&P 500 plus 0.79, Dow 30 up 1.3%. So the top 30 companies, give or take, are still doing well today. NASDAQ is up and down in between green. Let's take a look at Tesla. And I'm just going to go to statistics to get a look at the valuation multiple over time. All right, so the thing that you have going for you if you're a Tesla fan right now is they are profitable. They're 100% profitable. They're producing an EPS. They have a decent amount of cash versus debt. Certainly better than anyone else in the automotive industry of note anyway. But you're still in this point. This says forward PE of 133. We're going to take a look at that here in just a second. But no matter how you slice and dice it, I would say, in my personal opinion, Tesla has enough predictability right now that their PE should be, their forward PE should be at least under 100. And that, I think, is being gracious. You look at that PEG ratio, 2.9, 1 or under is about what you're targeting in the best stocks. And you got price to sales of almost 30. You're not going to see that in the industry very often. But let's just take out the industry for a second. Let's go straight to the projections. So here's Tesla. This year, I'm just going to say it's done, right? We're at the end of 2021. I've been preaching that a lot. Sorry, I get a little reload there. And let's take a look at 2022, because that's really what our forward PE should be looking at right now. The consensus is 817. Now you do have a high of 1130. Okay, so let's just go, I'm going to say that this goes up to, I'm just picking a number, $9.50. I'll pick somewhere in between the spread. And then you multiply that by 100. So again, a gracious forward PE of 100. You have a price of $9.50. And that to me would be like maybe the fair price, okay? And that anticipates more than the consensus EPS, and it's giving you a free pass at a forward PE out of 100 at a time when we anticipate lower interest rates. I think that's 100% fair. So I wouldn't get too excited about any sort of market correction until Tesla's in that 950 range. And even then, I wouldn't say it's on sale. I would say it's fairly valued at that point. All right. Just out of curiosity, Morningstar is still catching up with Tesla, but they put fair value at 680. Morningstar probably will struggle with that one for the same reasons we all struggle with Tesla, and that is because it's just hard to compare the industry. Can't really compare GM with Tesla, but if you did, or Ford or anybody like that, if you did try to compare them, you are looking at industry PEs in the 10s and 20s. Let me just look for fun. So if you ever woke up one day and you said, you know what, Tesla is a car maker, that's what they do, or they started spinning different things out. Here's Ford. Let's go annual. Under 10 on a forward PE. I think Tesla deserves more than a 10 for the pace that they're growing, as well as the fact that they have other tech interests, and just their factories and stuff are worth God knows what because they're brand new. So I'll give it to you. They don't deserve a 10, but we are, I gave them 100. That is 10x what Ford gets. So I think that that's fair. All right, so that was Tesla. So I had QQQ as reason number one, the RSI of the QQQ. Reason number one, we are not in a situation that I would say things are on sale, crash, correction, whatever. Tesla was reason number two. I gave you a few points there. Now let's look at Microsoft, another huge component of not only the QQQ, but I assume the Dow 30. Microsoft hasn't been touched yet, really, by this at all. And if we go to forward PE, that's non-GAAP. Let's go to forward PE GAAP. We're lucky with Microsoft because it's such a profitable company that we can actually use EPS in a realistic way. So PE GAAP 30.29 is the 5-year average. And that's important because the 5-year average, of course, is going to incorporate pre-pandemic, pre-0% interest rates. And it's also, now that we're in, basically year 2 of the pandemic with low interest rates, you're going to get a couple years on there to give you a nice 5-year average. So that 5-year average is 33.83, and that is about 3 points off where you sit today. Now, if we go, so let's just remember for a second, I'm even going to write it down, 33.83. All right, now let's go to our earnings estimates. Microsoft is smack in the middle of their 2022 year. Right now, the EPS estimate is 917. You have a low of 861, a high of 972. Microsoft's range isn't going to be very broad because they make a gajillion dollars, right? There's not going to be a ton of surprises on Microsoft's EPS. So let's take our math, 917 times the 5-year average, which we said was 33.83. You have a price of 310, okay? That's just using the simple, consensus across the board. So Microsoft at 310 could have, arguably another $20 to go before you would say at that price, at 310, Microsoft is fully valued. Not necessarily expensive, certainly not on sale, just fully valued. And you'd probably have to get to threes, 295, something like that, before you would, call your friends and say Microsoft's on sale. Because this is a forward PE that will be with us through June of 2022. So, if you're buying it at 310, or what was the number? Yeah, 310 was the number. If you bought it at 310 on the math I just did, and the world stayed the same, and Microsoft hit their numbers but did not exceed them, then you are basically buying flat through summer of next year, right? So that's not a sale. All right, so that's Microsoft. That's point number 3. Let's get into Nvidia. We know the great year that Nvidia's had. And with Nvidia, they typically report in non-GAAP numbers. So we're going to go with that because that's what the street uses for this particular stock. So you've got non-GAAP forward, 5-year average, 40.67, okay? That's the 5-year average. That's some pandemic low interest rates. It's some prior to that. So we'll just round it up to a 41. Make it easy because these decimals are killing me. And let's take a look at their earnings projections. All right. So they have a fiscal period that ends in this coming January. So for all intensive purposes, that fiscal period is over, right? We're nearing the end of this last 3-month stretch. So we're just going to use 2023 numbers, January of 2023. This is a non-GAAP EPS estimate of 515. Okay, 515. So 515 times 41, we said. That's a price of $211. All right, we're at 318, and even if you basically triple disagreed with any of the numbers that I'm using, let's just say that they're worth 275, which doesn't even work out on the math. You got a ways to go, right? You got an easy 10% to the downside on Nvidia, minus some sort of huge press release that we just can't even foresee coming right now. So until I see Nvidia take a haircut, doesn't mean I won't be buying things that are hit. It's just I won't be super excited about the prices that were being offered in the top of the stock market, right? I think like when Nvidia, if and when Nvidia goes 10, 20% down, now you're talking about a time where the QQQ becomes a lot more interesting than it is today. But as long as Microsoft's sitting up there basically losing nothing, Nvidia a long way to go down, in my opinion, not because it's a bad company, just because it's run up. I need to see those two take a haircut. I need to see Tesla take a haircut. And there's one more, Apple. All right, 161.26. Apple, very similar to Microsoft, super predictable because they make so much money that you can never wake up and have plus 25% revenue, plus 25% EPS. It just does not happen when you're talking about the billions of dollars that they generate. So PE gap forward, right here, you're at a 28, 5-year average, basically 21, right? So we got a 7x or a 7-point difference between history and today. So I'll give them a 21. Let's go to earnings. Earnings estimates. And their fiscal period ends September 2022. Okay, so that's far enough away we can use this number. 570. You got a low of 520, a high of 612. So that's a little bit broader of a spread than we saw with Microsoft, I believe. So I'm going to give them 575, just for fun. 575. They had a mildly negative headline today where they said, like, they told their suppliers that demand was suffering very slightly on iPhones. I don't know if anyone ever quoted the source on that, so take it with a grain of salt. But 575 times historical or 5-year PE average puts you at 120. $120. Today you're at 161. This is a week into this kind of market, downturn, if you will. There's room to go, and this is just the top dogs. So I know that the growth stocks are getting slammed. Anyone who has a growth stock, particularly those without earnings or profitability, you've certainly seen your valuations tank. But if you really look at it at the top of the market, there's still some more room to go. So that was my lead off there. Let me take some questions here. One second. Flip these back and forth. I'm not the best camera guy in the world, obviously. All right. So Jimbo was here first, and he said, should we wait until 2022 to buy? Everyone just tax harvesting plus debt ceiling. So I sold some things that I didn't think were going to come back. Most of you know I sold Etsy. Looked like I got lucky and sold it at the top. It's come down just a little bit. I thought it was wildly overvalued at almost $300. I also just yesterday decided to get rid of Smile Direct and take that tax loss. I have no reservations that I'll be able to jump back in Smile Direct for lower than the $7 that I was at, $7.50, because they just can't get out of their own way. So I did that one. I think, like, for me, if you run a smaller account and you can get up to, this is for America, if you can get up to your $3,000 in write-offs, then that's how you should do it in stocks that you believe you could buy back in January for lower than your current cost basis. So that's my 2 cents. And you still have December to go through. So there could be one of those things that I was going to hold Smile Direct till I thought the floor was the floor. I don't think it's the floor yet, but I just decided to get some cash ready, get that transaction done, and that way if QQQ does reach a point that I'm super excited about it, that's when I'm going to be piling into that one. But I have been buying some QQQ, but I have not. It's literally like one piece here and there. Jimbo, you think DraftKings is a buy? I think it has risk to dip more, and it is now below my cost basis of 34. And I don't say that because I've lost any conviction at all. I just say that because look around at what's going on. DraftKings under, let's call it $30. I don't know. It seems decent to me. I like where their revenue's going. Let me put that one up here. All right, so DraftKings is here. Let's just do a 1 month chart. You were at 47 to kick off November. Now you're down to 31. You're really going to struggle, much like so many growth names. You're going to struggle to find a fundamental valuation for this one. Best we got is 10x sales. And, you know, I think that that's fair. I think that they're building some properties that, and by properties I mean online properties, that will have a lot of intrinsic value, and I think their revenue numbers are not even near what they'll achieve in the next 2 or 3 years. So the question though is, if this thing would load, and this is just pure opinion, do we think DraftKings will be available in January for $32? And that's a hard one. That's a hard one. I think that you head into January and you start talking about the height of Super Bowl, which is a huge event for them. I think you also start to see in this date range, February 24th through 28th, you get that Q4 earnings report that encompasses a full stretch of football. And then, you know, there's going to be a lot to listen to in this call. So if I did not own a position in DraftKings, I would probably wait for the downside only because of where the market is. So hopefully that helps. All right. Who else is on the board here today? Kevin, good to see you. Kevin Hawthorne. Joseph, hello, just getting started. It would be nice to learn about this world. Keep waiting, Joseph Kemper, because you could be coming in at a good time if you saw the stock market go down a little bit. And if you really are brand new, probably most of us here would say buy an ETF, which is just a collection of stocks. You can do all that research on your own. Investopedia is a great place to go online, and you could read hours and hours of content on Investopedia for free to help you learn some basics about the stock market. So that's where I would go. You don't need to buy a course. You don't need to sign up for somebody's monthly whatever. You can go out and learn this stuff pretty much for free. And if you're doing an ETF, your risk reward, assuming you get the a nice low expense broad ETF, your risk reward should be great over many years. Cody McKay, holy moly, actually caught a live video. Good to see you. Most of my stuff is heading back up so far. We are seeing, let me refresh this here. Right now we're at 0.6. The NASDAQ, man, it just cannot find a spot. This Russell was super down lately in this stretch, and now you got 1.39 on that, so that's good news. Dow 30, and look at that, and S&P 500, the QQQ, was down slightly when I started this live stream. Now you got people buying. But this has been pretty volatile today for such a big ETF. 386 peaked up at 390, then down to 384, now working its way back to 390. So it's got a lot of action on it. I don't know that I would buy anything on a green day this week, to be honest with you. If you see green, I don't know if I would buy. I think that you can afford to wait for another red day or a red time in the market. 10-year bond, 144. This is kind of interesting because of the way that, the Fed has been talking about, a tapering or, stopping their purchases of mortgage-backed securities. And these stupid charts keep reloading on me. If you go out 6 months, this is 6 months, right? Your peak was 167, it looks like. About the same on November 23rd. And now, like in all this hoopla of the markets, this is actually going down now. So a lot of this so-called risk for interest rates has not materialized, certainly based on the purchase or non-purchase of mortgage-backed securities. I think it's really what it's going to come down to is like the Fed, like legitimately increasing rates, which is a lot different than them going in and buying securities. So we'll have to see when that happens. This is kind of what spun everything down the spiral on Monday at the Senate hearing, when they were just talking about, we might pick up the pace a little bit, and that immediately tanked the market. But tanked, right, is a relative term, as I've already been through. Josh is asking about GAAP. Jimbo's gotcha. GAAP is an accounting method. And that's another one. Joshua, if you're in the same boat as Joseph, you want to go to Investopedia. I don't know. I don't get any money from Investopedia, by the way. So they have so many cool things. I'm just trying to show it to you here. I'm going to have to rebalance the screen. And this looks like the last article I was on. They have all kinds of cool stuff. Do trust beneficiaries pay taxes? I forget why I was down this rabbit hole. But you can learn so much about money here. General, let's see what their stocks. You got meme stock definition. But the best thing I will say for anyone who's learning anything in the market, including myself, I use this all the time, is just typing in terms. So GAAP, right here. It's not just a definition page in most cases. It is, they got the key takeaways. They go into here and tell you what are the differences and why it matters. We're not going to cover that on today's live stream, but this is a great website. I don't know if they have an app, and I don't know what Academy is. Is this free? Self-paced online courses. How about investing for beginners? Oh, they do want to charge you here. So I don't think you need to pay for that. Can I just be honest? There's so much stuff out there on the internet. I would just stick to their search bar and some of their definitions. And again, get in and look at ETFs and search for low-cost ETFs, something like that, and start your journey there before you buy anything. That's how I started. And there's so many cool ones out there. Some of them are riskier than others, but you can have fun investing with ETFs for your first year easy, and it'll give you a little bit more of a safety net. But I do recommend Investopedia. I'm sorry to say that Academy course, they were charging for that, but I think that you can also navigate around the site for free. I go to it probably 5 times a week, just looking up different terms and different events, and I've never paid them a nickel. So don't feel obligated to give them money because it exists. It's what you call an SEO property, a search property. And that the entire reason that they've built it is to attract traffic, much like a Wikipedia or something like that. So you are fine to not pay and just do what most people won't do, which is research, and read. And those are very important components of the stock, learning about the stock market. All right, let's see. Echoes from above. I think I'm going in order. DraftKings CEO just responded. I saw that. So, Mr. Robbins, his last name's Robbins, but he did come out. Let me see if I can find it. With a tweet that basically said, we'll see you guys in 2025. All right, so here's his feed. He's a good person to follow if you do buy DraftKings stock. Jason Robbins. And I don't know if I'm going to find... I don't know if I'm going to find the actual tweet, but anyway, browse through it before you buy DraftKings and just learn about the company, because he's very open about stuff about the company. You know, he comes in here and does little updates, but somewhere in his Twitter profile, he had a tweet that was like what Echoes from Above said, like, hey, if you don't like what we're doing, which obviously Twitter's a shitstorm and everybody feels like they're superior to everyone else, he is like, we'll see you in 2025. You want to bash us, you want to bash our growth story, you want to say we don't know what we're doing, call me in, you know, whatever, 3 years now. And that's where my heart lies with DraftKings. I really do believe that I thought the return over 1 year would be better. And honestly, it was, because it hit $70 a share at one point last football season. And you had multiple opportunities to cash out in the 60s or 50s. Now, obviously, there's pressure on growth stocks. Wouldn't be surprised if we see some more dip opportunities with DraftKings. But next year is not a guarantee to be like the year, but more states will be coming online. We had a handful of states that were delayed, including where I live, which is Ohio. They were delayed. They were supposed to be live. Big shock. The lawmakers couldn't get out of their own way and delayed the Ohio bill. Now they're talking about potentially approving that in March with a rollout in summer. Who knows? You're waiting for these figureheads to sign papers, and it's a pain in the ass. But we are not even close to saturation in America. And I believe the last video I did on DraftKings, which utilized their investor report, I believe they said, God, I want to say 20 to 30% of the available market is live. And so long way to go. Don't be surprised if you see a lot of peaks and valleys in DraftKings. I use the product. I'm a huge football fan. I play the daily fantasy, which is legal here in Ohio. I will have fun using the sports gambling product when it is launched. I do not mortgage my house for it. It's all fun money for me. But if you like that game and you follow some of the guys that do it on Twitter, like, it is nuts. Like the 15-leg parlays and stuff like that you can do for basically $20, if not less, and have a chance to win a ton of money. You need a lot of stuff to go in your favor. I'll tell you, on the daily fantasy side, you need a lot of stuff to go in your favor, but it's fun for the right person. And that sports side of it is really not even the creme de la creme. It's the iGaming, because iGaming is basically everything you'd see at a casino, except now on your phone. So whether it's roulette or blackjack or poker, whatever, even slot machines, not going physically to the casino, you can do it all on your phone when things are legalized. That when you start to see that, when you start to go to lunch at work and you see somebody on their phone playing a couple hands of blackjack or something, that's when we should be looking at DraftKings full valuation. And that day is not here yet, but it's coming. It's coming. If you have scratch-off ticket, I don't know if you guys have scratch. I assume everybody has scratch-off tickets for the lottery or whatnot in your state. They're like crackheads, man. They just like spend so much money on scratch-off tickets, and I have a feeling that a lot of that money is going to switch over to companies like DraftKings when you get the phone thing going on. Scratch-offs are a losing battle. It's a one in whatever chance. It's totally calculated, whereas somebody who's well-versed in blackjack is not guaranteed to win any money, but you can certainly stack odds in your favor with blackjack. It's been studied a million times. I'm not saying it's easy to do. I'm not the guy to do it, but there's just some common things you can do in blackjack, common strategies to avoid losing your shirt, and I think that will catch on very quickly in America. Not to mention, I'm probably older than most of you, but there was a time in America where online poker was legal. This would be like late 90s, early 2000s, like partypoker.com and whatnot. Dude, I had friends making a ton of money playing online poker, which poker obviously is a game of skill. They're dying for noobs to get into those games. Unfortunately, it all got outlawed and they shut the sites down. I don't know if you can do those sites anymore. But if DraftKings, if the policies allow for poker rooms in these casinos, just get out, because it is going to be nuts how many people pile onto that. All right, let me grab a drink here. Ekka's got a couple more things. Yeah, so Ekka's was going on about Robbins. He loves his response. Me too. And I think if you have DraftKings, you just have to know that peaks and valleys, man. Peaks and valleys. This is probably my riskiest bet. No pun intended. DraftKings stock has no fundamentals to support the $30. Compared to me, I was just nitpicking Apple and Microsoft. DraftKings doesn't hold a candle to them from a fundamental standpoint. But I know what the opportunity could be. I use the service. I've put money in. I've taken money out. I know it works. I know that it's fun to do on your phone. That's why I'm holding. Okay? So if you don't know anything about the industry, never played daily fantasy, you've never done anything, or even interested in casinos, then I don't recommend buying it, because you won't know enough about the industry to make a logical bet on it. All right, Cody says, super bullish on DraftKings as well. Just buy and hold for 5 years. Yep, I think we're all on the same page with where mobile gaming is heading. Yeah. I don't want to go on about DraftKings. I'll say one more thing, though. Some of these games that they've invented, they're in the investor report. You got to look at it. There is like a climbing, it's sort of like a chart, right? And a little ball moves up. I wish I knew the name of this thing. It's like a Eliminator or something. And you basically put $1 down. The ball's going up. There's 25, 50 people in there. And as the ball goes up, you can cash out or you can keep going, but something happens at some point where you would lose it all. So theoretically, I have not played this. I don't want to promote something I haven't played, but theoretically, I think you could cash out the easy bet every time and probably make, a dime or something. But the more you go up, and if you hit it before the other guy does and you get out, you can literally double your money. And that's the kind of goofy stuff. I bring it up because Cody mentioned iGaming. That's the kind of wacky stuff that's coming to this world, man. It's going to make risk in the stock market. It's going to make buying CrowdStrike look like the safest bet on the planet compared to what's going on there. Let me push this phone. All right. All right, enough about DraftKings. Derek's here, wouldn't touch DK. They don't make money. Yep, that's the fair counter argument to DraftKings, and I'm not here to argue that. And I think you guys know that I'm pretty open book about it, that there's no fundamentals. Jimbo. So let's skip past this DraftKings a little bit. Let's get down to Eric Lee. Do you think there's a risk of investing into the mega caps? I do, sort of. If you missed the start of this program, where did this stupid question go? I think that that's the next leg, is mega caps, because they haven't been touched. So if you want to go back and watch the replay later, I talked about Tesla. I talked about Microsoft, Apple, and one more, Nvidia. All four have an error of overvalued at their current price, and almost all four of them have been untouched in this pull down, certainly respective of their overall prices. So that's my whole case here, is that the top is still heavy, and arguably, let's see where we're at today. I've been rambling so long about DraftKings. All right, so here we go. You have S&P 500 plus a percent-ish. Dow 30, the heaviest of the heavy, 1.36%. NASDAQ as a whole is fluttering between positive and negative. QQQ is, all but flat. And in this short little video that I'm doing, we've seen the QQQ at minus 0.5%, all the way up to the direct opposite of that, and now you're floating in profitability. So call me, or how about this? Let's not call it a correction. At least I would say Tesla should be under $1,000. You can start talking about maybe a correction when this is under $1,000, easy. And you can start talking about a correction when this guy is probably closer to 275. And by this guy, I'm saying Nvidia. Okay? Historic run up, great company, nothing but great things coming down the pipeline for them. But there's no way, dude. There's no way that this is a correction when those things are doing what they're doing. All right. So hopefully that helps Eric Lee. Derek, that would require... Okay, I'm skipping the rest of the DraftKings comments just because we spent a lot of time on it. Hey, Igor, how you doing? Small caps are getting crushed. It's interesting, though, if you saw that last chart, look at the Russell today. Now, formerly, the Russell has just been abused, really over the past month, okay? Now, there's 2,000 stocks in here. So it takes, quite a bit of a trend to get this thing moving. And I guess you did have a small peak on November 5th as I switch out to the 6-month. Yeah, November 1 through 5 was the high. And now you're roughly back to January if it goes down a little bit from here. So small caps have not been good. And one of the things we know about small caps, not all of them, but a lot of them lack EPS. They lack profitability. And at least from my taking the pulse of the market, those who lack EPS and profitability have been the ones to get creamed, because you cannot reasonably look in the mirror and say 30, 40, 50x sales is a good metric. And if you want to back down and start talking about enterprise value calculations, That's fine if you want to. Just realize that that has a market cap component to it. So as quickly as your Rivian gained market cap, as soon as it loses it, some of those EV values go out the window. So you do have to dig in and find your happy place with companies without revenue, because you're not going to have a defined floor from a fundamental perspective. They're not going to show up on a stock screener if they don't have certain metrics, and if they're not showing up to investors, investors are not going to buy them. So, you know, that's the one thing that I said is behooves the Microsofts and the Apples. I understand why people go there, because pretty much their EPS is locked and loaded for this year. It's pretty much locked and loaded for next year. It'll be 5 years before you start to get down the Apple corridor and you say, well, what the hell is going to happen? They already know what they're going to sell next year, barring what we've just been through with pandemic and supply chain. They already know. They've been doing it a long time. Microsoft already knows what they're selling next year. You know, everybody who's selling cloud, the Microsoft division that sells cloud, they know all the big contracts that are coming. This isn't a fly-by-night operation, right? If they've got a pipeline into government contracts, they already know. You know, we've got Tim is the salesman for the Pentagon. He's got 4 on the plate. Of those 4, 1 or 2 might hit in the contract. So let's just say, you know, I'm making all this up, that we'll almost for sure get $100 million from the Pentagon based on these 4 outstanding proposals. So Microsoft, Apple, who probably can predict consumer behavior better than any company in the world, that being Apple, there's no surprises. They just keep churning money, and the only surprise is when they have a new product line. You know, that's the surprise with Apple. So when they say iPhone 14, people get excited. Obviously, they sold, you know, the market was sold hook, line, and sinker that 5G changes the world instantly. That was false. As we saw, 5G is good. 5G will, you know, induce a cycle of phone upgrades. Does not solve world hunger by any stretch of the imagination. And we saw that with Apple. It was good, not great. Not everything you read is a bull case that is 10x, right? Some things are just growth. And I think that that's where me and perhaps some of you bid on some wrong bait that was swimming last year in the analyst world about, you know, this, you know, connected TV is going to blah, 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 blah. Connected TV is going to grow at a steady pace. It's not going to triple in a month, right? So you have to just put a lot of stuff into context to really understand where the sales of a company are going. And if you're like me, you probably read too much. And that's, you have to be careful, because there's a lot of stuff out there. Trevor Johnson, see you, Jeff, how you doing? Covered most of Snowflake, but got some short. Nice. Snowflake, I got confused. They had a good earnings, right? Okay. I was confusing Snowflake with Okta in my brain. Let me adjust this so that we don't have that stupid menu bar blocking everything. All right, so Snowflake, I just heard this on CNBC. They had a good earnings, I believe. This is Snowflake surges towards best day since May. Snowflake pops as earnings top views. Revenue growth handily beats estimates. So good day for them. I'm not sure. Yeah, they're not profitable, but they do have that growth, that projected growth that people are clamoring for. We'll see if they can sustain it. Projection of 63% next year, almost 100% this year. So this is one where they can't back off that number to sustain this price. Let's see what this price is. This price is 128x sales. So this ain't cheap. All right, okay. I don't know why the screen keeps reloading, but it does. 120x sales current, and that probably doesn't incorporate this plus 12x or 12% bump that we saw today. So watch out, because they are definitely a negative headline away from losing 20%. But they have not had that, and it's been all good headlines. So for those that are in there, good for you. Let's see, Chestad, when the other guy's portfolios drops 5%, it is a dip. When your portfolio drops 5%, it is a crash. This is true. It always hurts more, and I think, you know, as you guys saw the growth names that took a hit, whether it was, you know, Cloudflare, CrowdStrike, you name anything like that. I mean, let's throw my DraftKings in there. Let's throw anybody in there that is not profitable but has a high growth rate, C Limited, etc., etc. There are people, that's their whole portfolio, is those names. I was going through Twitter, and people kind of share some of their tickers, you know, and they say, here's what I like for healthcare and cybersecurity and all this. And it's like, dude, you just lost 30 or 40% of your money, because every single stock that's on your little list there is not a profitable company yet. They probably will be. So if you're holding 5 years, good for you. You're going to make it. If you bought this with your grandma's money because you thought you're going to double it in the next 12 months, then you're probably screwed right now, because it would appear, at least from a sentiment standpoint, that we're at, I would say this, the sentiment of the stock market reaching the same valuations that we saw 6-7 months ago. I don't know that we'll bounce to that factor again. It doesn't mean that there won't be overvalued stocks. It doesn't mean that CrowdStrike is going to go down forever. It just means that I think the peaks on some of those are over. You're over a year away before you see them again, because there's just not a lot to support it. I was watching Trade Desk is just in a watch list of mine, and I don't really study it. I know what they do. I haven't really got into investor reports. And I did the game of, you know, they had a big earnings push. They had great earnings, so they hit 107, right? And then we had this like bleed out that we had in the market. I'm like, oh, they're back under 100. You know, how far are they off of a fair value? And look at this shit. So 4 PE over 100, that's probably fine. In today's world, it's not ideal. I think you want to be sub that, but 42 times sales, PEG ratio 436. The goal is to get under 1, right? They've got a ways to go. And you might look at this, wherever I was, 6-month chart, and you would say perhaps $68 before the run-up was where they should have been in the first place. So they probably should have been lower than $68, then have a nice earnings report, and then just stay at $68 would have been about right for this one. And even then you could have argued. So now, all that being said about growth stocks, and we'll just use the Trade Desk for an example, you have to be careful what you listen to, because there's two kinds of people that are going to talk about Trade Desk, and they're going to have two very different opinions. What I just showed you obviously was a little bit bearish. I said that there's room to run out. I said the same thing about Nvidia, Microsoft, etc. Now, if you bought those stocks 2 years ago, then you're fine, okay? You don't have to worry about Apple or Nvidia. You're so far in the green that you just let them run. When I'm talking about today, I'm talking about you don't have a position. I don't have a position in trade desk. Should I buy it today at 95 some odd dollars? And where the way I looked at it is, if you do, I don't know that you could guarantee yourself a positive return over the next 12 months. And in that case, if it were me, I would try to wait. So now there's another guy out there, or girl out there somewhere, who bought Trade Desk 2 years ago, and he or she's like, dude, 95, going to the moon. She's fine, right? Because she bought at 30, and I think they had a stock split, so she bought it at the 300, and did the 10 split. And so her cost base is 30. What does she care that's a 95 and overvalued? So, and perspective is everything. Perspective is everything. And when I'm doing stuff on this channel, I try to look at it from a today if you don't own it. So sometimes I'll do like there's a Microsoft like price projections, and I'll say, you know what, this Microsoft is fairly valued. I don't see a ton of upside. And people will be like, dude, you're crazy, like all, you know, blah, 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 blah. It's like, man, if you bought it at $50, you're fine. Like, you shouldn't even be watching my video. This is a video for people who do not have a position and may want to buy one. It's a big difference. Derek, everyone just needs to relax. Long game. Put a few dollars into stuff you like and forget about it. Assuming you've done your homework, you can sleep. That, I think, sums it up well. We really shouldn't be looking at stuff on a daily basis. In my situation, right now here at the end of the year, I'm kind of excited that I kind of am disappointed if I load the homepage of Yahoo and see green, because I would like to, after selling out of Etsy and selling out of a couple bad choices, I would like to get into something that's more or less on sale. But to Derek's point, if you're holding 3 to 5 years, maybe longer, just like I was talking about with, say, Trade Desk, then I'm not sure how much it matters about today. Cloud Developer says, do you think the European payment EPI is a threat to Visa long term? I don't, but it's probably not the greatest news in the world. Generally speaking, I never believe that any government can do a successful IT implementation of any kind. Right, I think that they have to outsource literally everything. Can't speak a ton for Europe because I don't live there, but governments trying to take over technology is 90% of the time a losing battle. And my guess is that regardless of how they do it or think they're going to do it, that Visa will have a better way to offer to merchants, not to mention tourists and travelers who are coming over. I just think that I'm never going to bet on the government to successfully launch anything information technology. All right. Echoes from above. I'm skipping that. I think you guys are still arguing on DraftKings. All right. I'm skipping the DraftKings. I'm going to go down to, wow, DraftKings got out of hand in the chat. Cannabis stocks. I don't own any. We had that flash in a pan of a potential legalization here in the United States. I don't know where that's ended up. I'm going to pull Tilray because it's the first stock that came to mind. However, I'm sure there's better ones. Here's Canopy. Canopy, fair value of 22. I'm going to wait for a second because Yahoo's been reloading these charts. Let's see if that happens again here before I start talking about it. Looks like they're down. This must have been whenever that legislation rumor was going on here in America. Now you're down to 10.12. I'm not aware that any of these particular companies are profitable, and so you're banking on growth, and I just don't know how you separate one from the other. So I'm not in on any of it, but you know, is there a market for it in America that can make money? Yes, it's probably like the dead ass same thing as DraftKings to some degree. We know it'll be taxed heavily in America, just like gambling is. And those, I guess you just have to ask yourself, which way do you want to play it? Do you want to play it on the agriculture side for someone who produces, ideally at some sort of infinite scale, that they can make a little bit of money off of a lot of transactions? Or do you want to do retail like, what's his name, Jeremy at Financial Ed's got that one, Planet 13 or whatever it is. You know, that's a retail store, probably has markups from a retail point of view. However, their sales, their revenue number is never going to be the same, I'm guessing, as Tilray or some huge producer. There's two ways to play it. Generally, you would argue the retail, if you think about chips, right? If we think about TSM versus AMD, TSM makes chips, they make a little bit of money off making a shit ton of chips, whereas AMD makes nothing. They have TSM make it for them, but they put a pretty box on it and they mark it up for retail. And, you know, if it's a good market, the AMDs / retail people are going to make more money than the producers or the factories. So is Planet 13 a good retail play in this? I have no idea. But I think so far it's been going up. This market, I would not be super, I guess if I had to play it, gun to my head, I would say pick, if you're interested and you feel like you know something about it, pick the one or two that you like best now while it's down. Wait for however long the legislation is going to take and either sell that news, like we saw the run up on that stock chart, sell that news, get out right then. Could take a while because what is going to happen is there'll be a headline chase and you'll see this peak when legalization is actually announced, ideally at the federal level. And then once that news is over, reality sets in and all these companies have to make money off of it. And I can't imagine for the life of me that year one is going to be profitable. Just because of the amount of infrastructure that it'll take for them to deliver and farm and whatever, you know, orders going crazy. So that's how I would play it. Get in something now, sell the headline when it comes out in a year or two, and go from there. All right. Jimbo and Derek are all in on this DraftKings still. Terracina Drive asks, do you think Baba will get delisted? I read an article on Seeking Alpha that I thought was pretty informative, and basically that person was insinuating no, that it was, you know, and I'm taking some guy's opinion, but he had a pretty good map out of how the whole system works and how the government would be involved, and he was saying no. So take that for what it's worth. I would encourage you to type that answer into Google, and it's an opinion right now, right? It's an opinion that it could happen, and it's an opinion that some folks say it will not happen. Nobody knows. Nobody who's on this YouTube stream knows the answer to that question, but you can read different viewpoints from folks who do know what the hell they're talking about, and that's where I would go with it. Elizabeth, I accidentally skipped you. Have you added to PayPal? Yes. I bought 5 I think I've bought 5 or 6 total shares over the past 7 days. So it brings me to about 75 or 76 shares, I can't remember. And I will continue to. You guys know I'm a PayPal bull, but I will tell you that it does have a chance to go down if things get rocky. Hold on. Here's your Morningstar fair value. It could do a 151. All right, it could easily do a 170. And we got into the 170s to start today. Let's see if it's on here. 180. Oh, I think it opened at 179. It hit the 170s late in the day. I will probably add piece by piece under 180 at this point. And I'd love to get to 100 shares of PayPal for the long term. And you know, Derek made the point about do your homework, sleep well at night. For me, on PayPal, that's where I stand. But don't be surprised. Don't freak out if you see 150, because quite honestly, now that these numbers are getting adjusted, you've got 528 for your, estimate of the forward PE. I will say PayPal has historically outperformed consensus, but let's just assume it's true. 1 second here. 528. I'm just writing that down. And then we'll do the same thing we did with Apple and Nvidia. All right. So they are reporting a non-GAAP. 5-year average is 40.24. They're actually lower today. So that's actually $200 on some rough math. Did I get that earnings date right? Yeah, that's 2022, 528. So it's better than I thought. But I would still be, there's just so much negativity in fintech right now for some oddball reason. I'm going to kind of wait around for 170s or something and buy from there. But my goal, I would be happy if I hit 100 shares of PayPal, because for me, that's a pretty daggone big investment. I'm not that big of a high roller. I have a retail account that's in and around 100K and lost some money this year. So if I could have 100 shares of PayPal to write calls and stuff on, which I've always wanted to do, then that would be a big accomplishment for me. I do think that Visa is arguably the better deal between the two right now if you just want to go historicals. And they're at 197. That Visa at 190 yesterday, 190, that was pretty sexy, I thought. That was an interesting one, because you're talking about $8 some odd in earnings. Let's see what their 5-year average is. They reporting GAAP forward 5-year average of 32.69. So they're under that right now. So if they did get back up to 32, let's just say they got to 30. Okay, 30 for a forward PE on 841. You're talking about 240 some odd dollars on a stock that's 198, and that's reasonable. That's not a pie in the sky kind of thing. So the only X factor that comes up here with Visa, as you guys know, I've talked about it sort of ad nauseum, is the cross-border transactions. And of course, if this new variant affects travel and we lose cross-border again, it's bad news. Visa's kicked ass in developing their e-commerce and all the other things they do outside of cross-border. During the pandemic, they've brought those other business lines up in an unbelievable manner. If they could just get cross-border back, then there would be something to it. They would really just go, not to the moon, okay, let's be realistic, but they would be in such good shape. So watch the pandemic. I'm not yet scared of the variant, mostly because the little bit I've read, do your own research, the little bit I've read said if you're vaccinated, the symptoms were mild. Is that true? I have no idea, but that's what's been in the news. All right, I'm going to hit LD. And, and Andy, I went down to the most recent, is in on CrowdStrike and Datadog. Very interesting. But I want to hit LD. Check out OLED. I've been watching it. So I'm glad you brought this one up. OLED has been in trouble. So this is a company that owns patents, processes, and materials for everything that goes behind OLED screens. And the penetration numbers for the future of OLED look really freaking good. And so if you see this one, Tank, you should add this to your watch list. If it gets to a place that you're excited, P ratio of 35, next year, 518. So let me do some quick math. Let's just give them a 32 PE times 518. You could definitely be in the 160s as early as January on this. I'm interested in this one because I also think it has a limited risk profile. So I'm glad LD brought it up. The only reason I haven't pushed the button that I'll tell you guys right now is I have a computer that I'm on right now. I do Windows, I'm not an Apple guy. And I have an OLED screen, and it did get the stupid burn-in, man. OLED is prone to some burn-in, and I wasn't really aware of that until I started reading about it, and my computer's 2 years old, and I didn't buy the whatever bullshit extended warranty they try to sell you for half the price of the computer. So I do worry about burn-in for OLED. Do your own research on that. There's a lot of people who suggest that risk goes away over time, and there's things that you probably should know before you buy an OLED screen because you can prevent it. I missed all those, and so here I am. Burn-in's not bad. I wish I could show it to you, but it doesn't show up on these little projector things that I'm doing right now. It's very faint, and to be honest, the burn-in for me is this view. It's the internet view, right? So right above, let me show you something here. So right this, and I usually have like a bookmarks bar that goes across the top, and so those little symbols got burned in. I close it. I close the bookmarks bar for these events because it's distracting because it's got a bunch of colorful crap up there, but just figure like Yahoo, CNBC, and they have their little icons. That got burned in, and so did some of these Chrome tools, right? So anyhow, that is the only reason that I'm a little sensitive on OLED stock. But if you go into their investor report, and you can also go to read what LG, the company, LG is talking about with OLED, there's a lot of reason to be excited. So I just need to get past the burn thing. So thanks for bringing that one up. It is on my list. I'm going to say, Derek Ridlin, I don't think a lot of people understand growth. If you buy a company that makes $1 and it grows plus $1 for 10 years, are you going to pay for all those dollars today? Heck no. So agreed. That's where, and we haven't had to talk about this world in over a year, right? Almost 2 years. That when you pay 100 times, revenue, and if you assume that revenue never went up, you'd have to wait 100 years. If revenue doubled, you'd have to wait 50 years, right? So you can understand how large valuations are doomed to fail at some point, because there's only so many companies, really the best ones, that do double revenue. And then ideally, when you're more mature as a stock, you double your EPS, right? So you think about Amazon's and Google's. And actually, let's be fair, Tesla's doing it on the EPS side this year and into next. Like, they're pushing their EPS at an insane rate, and that brings your forward PE down at a ridiculous rate as well. I still think 100 times PE for forward on Tesla might be pushing it, but everybody has their own tastes. But just know that some of these valuations are measured in years. 100 times revenue means if it all stayed the same, you would have to wait 100 years to really reach that point. And actually, I don't want to go down a rabbit hole, but if your revenue never grew, actually your forward multiple wouldn't change. So you'd be stuck in an infinity of doom. But that's probably not going to happen. You're kind of looking for that 3 to 5 year thesis if you want to go long. So while I've been picking on CrowdStrike and Andy came in and talked about he was buying it, if Andy's probably like willing to go 3 to 5 years, the way that they're currently growing, he's probably going to be just fine. And in that case, this is a sale. If you want to go by like true valuation, it seems expensive. However, its most logical comparison is to other stocks that are fundamentally expensive when you figure Cloudflare, Zscaler, all those things. I want cybersecurity. I want a cybersecurity stock. I'm struggling with where they sit right now. Guys, I got to run. It's lunchtime here in Ohio, and I got a couple things to do. Hope you guys enjoyed this. Really good to see everybody. I'm glad we had a good chat today, and I'll be back with more videos here soon. So have a great day, and we'll see you on the next one.